The world is watching this wedge pattern in the S&P 500. Will it break to the downside like they typically do in bearish contexts, or will it explode out of this downwards channel and the melt up continue? Oh, we're going to talk about that and more in today's Stock Market Brief show. We had that non-farm payroll come out, and let me tell you something. Talk about a massive amount of volatility. This is what we mean by the market just like really trades on that macro data. So it came out, hit to the downside, and then we recovered all throughout the day. Now, if we take a look at the 20-day chart of the S&P 500 on the 15-minute time frame, we are above that 5-day moving average, and I just want to point out how expansion leads to contraction, how we got to continue to watch these patterns evolve to maybe make for better risk to reward trading. As you can see, while price expands, it then moves to contraction. When contraction happens, it moves to expansion. You can see we broke down from this inverse head and shoulders, and we go through the same thing. Contraction, boom, we explode, expansion, contraction, boom, to the downside. We contract, we expand, we contract. Now we're sitting here currently in a broadening wedge pattern. Now, if you take a look at this chart, what's one thing that we can overlay? Well, if you just overlay this blue little box, you can see that we've just been in this chop box and we recently broke out and are back testing it. So what does this pattern typically resolve to? Well, over here, if it's in bearish context, your price objective would look like this, right? You would hit to the downside, you would contract, it expands, gets pretty volatile, and then breaks to the downside. So what would that look like? Well, it would look like this. It would bring us to the lower weekly expected move, which I haven't went over yet, but we'll do now. The lower weekly expected move for the SPY is at 400.18. I would just screenshot this so you can use it or mark them on your chart. This is where the closing price was for the week. This is the expected move. If you don't know what expected moves are, I made a video about that, which I'll try to link in the description or on the pinned comments or put here in the corner of the screen. But this right here is telling us where the market could potentially go for these assets. So SP 500, so SPX, SPY, Qs, IWM, and DIA. So it's plus or minus, right? This is volatility, so it can go, plus or minus, which tells us what? It tells us that it can potentially go to the upper realm or the lower realm. And just so happens last week, we actually hit both sides of that. So it was a very volatile. We hit both the lower and the upper bands last week. It's pretty volatile, pretty volatile trading week. So what can potentially cause the market to come down to its lower weekly expected move? Well, because the market's so dependent on all these macro drops, let's see what we got going on. We have a couple big things taking place as far as like major events. We have the ISM non-manufacturing PMI. We have balance of trade, PPI, and then we have Michigan consumer sentiment. So those are going to be some ones to watch coming into next week, and we have some obviously other ones there too as well. The ones highlighted in red are considered the major reports. Now, keep in mind too, we are in a tightening cycle, okay? This is looking at the Fed's balance sheet here, and you can see it has been heading down. How much? Well, if you just take a look in the month of November, where we started and where we ended, they are on track of what they said they're going to be doing. You can see how it went from, we'll just say 8.6 to 8.5. And if you see this article back here in August by Bloomberg, this was reporting that, hey, Fed's quantitative tightening to hit full stride with central banks shrinking the $9 trillion portfolio. And it said here, the unwind is going to be, this week to $95 billion per month. But this was talking about September. October will be the largest declines. We just hit November, and you can see they are still on pace doing that $95 billion per month. What else do we got going on? Well, here coming up very shortly in December 14th, we have the Fed raising their rate hikes or the Fed decision to raise rates. And as it stands right now, the probability, 78% probability that we're going to be seeing a 50 basis point hike. And there's a small probability of a 75. So chances are, by the tone of what the Fed said, we're going to be getting a 50 basis point hike. Where would that take us? Well, that would take us to levels that we haven't seen since December of 2007. Pretty interesting stuff. That was right around when we got this recession. And yes, we have a lot more debt. We have a lot larger balance sheet. So it's pretty crazy times if I do say so myself. If we take a look at the yield curve, this is the 10 and 2. This is the 10-year and 3-month. The 10-year and 10-year minus 2-year yield curve is at minus 77 basis points, and the 10-year and 3-month just hit minus 83 basis points. People, that is absolutely crazy. How crazy? Well, check this out. In 2000, and just so you know, in December, early December, which is crazy to me. So early December of 2000, right? The stock market has already gone down from its peak to where this happened to be was we're going to round it to 14%. And where was this curve, the 10-year and 3-month? It was at 83 basis points in early December. It's just so crazy how that works out. Not to say that the same outcome is going to happen, but it is pretty crazy. Now, if we take a look here in 2022, if we measure from where we were at the peak right here, down to where we are currently, we're about minus 14%, so off a little bit. And where's the yield curve at? Minus 83 basis points. Pretty gnarly stuff. What else can potentially take this market down or kind of break the wedge, right? Make sure that this wedge falls to the downside, or is it going to break to the upside? Well, if you take a look at the dollar has a very strong correlation to the S&P 500. I'll prove it here momentarily, but what you can see here as far as the dollar goes, this is also not a rising wedge, a falling wedge, which happens to be bullish because we are in bullish context. We're pulling down, prices tightening up. It's going to make an explosive move to the upside or to the downside, right? We don't know. It's contracting, and contraction leads to expansion. I will say that it is pulling into a level of support that we have been calling out. And in the S&P 500, as its rising wedge is taking place, which is more typically bearish, we have it pulling into an area of prior support and resistance. So what's going to happen? Well, that's a good question. I don't know, but we can take a look here at the correlation of the S&P 500 to the dollar. You can see on here, we're measuring it in different time lengths. So 15-day, we have 30-day, 90-day, 120, 180. And you can see here, if you just look at these numbers, minus 79 or minus 0.79, minus 0.93, minus 0.86, minus 0.55, it's a negative correlation. So even on the shorter time frames, it's a very strong negative correlation. So if a 30-day, it's minus 0.93, which tells me that when the dollar moves up, the S&P 500 can get knocked down. So if the dollar moves up, boom, if it breaks out, the S&P 500 can move down. Now, if the dollar breaks down from these levels, the S&P 500 could break through this area of support and potentially give us that Santa Claus rally. So that is going to be something to watch too. If we take a look at the 10-year yield, the 10-year yield is also coming off a little bit here. It's still within that wedge pattern, so we'll continue to watch and see what develops there. And then on top of that, bonds have been taking off to the upside, breaking out of this down channel, which is pretty interesting. Now they're getting a little too frothy, a little too extended. You can see with an RSI and also some of the other stuff that I track. You can see a little negative divergence right there in the MACD histogram, or sorry, the PPO, price percent oscillator Instagram. So we'll see if we get some sort of a back test and these things want to start ripping, which tells me if bonds now, right, if bonds start to get a bid, if they start moving up and they're starting to show, you know, a more of a risk-off type environment where we're seeing things like gold go up too, this all tells me that we're moving into that stage one, which is the early stage of the cycle, if you're looking at this sine curve of contraction. Okay, so now if we already know stage 6 is where bond stock commodities go down. This is what we've been seeing, people, and this is where we're actually in an expansion phase and we're moving down into stage 1 where there's contraction. So if this is the case where bonds start to pick up, stocks and commodities, they start to go down, where are we in this sine curve? Well, we'd be right here. And the bottom of the cycle is way down here. So if you really take a look at this and like you're trying to catch the cycle, it tells us that there is still downside. There's a lot of downside potentially too before stocks really start to catch a bounce. So yeah, can stocks rally from where they are, have an end of year rally? Of course, it's always a possibility and we got to be open to that idea. But when we're taking into account all these considerations, you also got to not ignore the fact of what can potentially happen on the risk aspect of things too as well. Now, if we take a look at the zones, you can see here, there's some green lighting up on the screen. What's that? That means this tells us that these price assets, the assets right here that are in the green, are coming to the lower range of their zones, okay? And you can see the dollar is coming to the lower end of its zone. Well, the dollar, as we previously stated, is wedging and coming into an area of support. Oh, what do you know? It's also coming into its lower band. It's actually right on it at the range is 1 right now, so it's right on it. And then on the flip side to that, we're also taking a look at the S&P 500, and the S&P 500 is getting to the upside, right? It's in the 90 percentile right now. You can see the close is at 40.71, and the high of this is at 41.05, so not too far off from the higher zone. Now, remember, these are dynamic. They're constantly changing, but they help you get a good visualization of, hey, potential upside, potential downside. Are things extended or are they not? And you can see that with all the red on the screen here. We've been seeing gold and silver and bonds take off, right? So you can see here, boom, TLT, gold, silver. Well, gold and silver are way up at the higher end of their ranges, and you have the dollar at the very low end. So this, to me, is staging for a potential part 3 of this bear market, or a potential pullback in some of these assets until we get some more clarification. Okay, we got a lot, like I said, to go over today. I want to go over to some anchored VWAPs and look at some various sectors, give you a good idea of what I'm kind of watching here on the markets. First and foremost, we'll just look at the SPY. The SPY got above this volume shelf profile right here and blasted up towards the year-to-date anchored VWAP, and we have this volume node right over here. So if we have some more upside, just be aware in this area that we might see some, potential area. I mean, it has room within this rising wedge structure to come up higher, but you can see that it might get a little stalled out up into this area. We'll see, and if it does, it can come easily snap back down to around that 400 range. So that is something that we want to watch out for. Let's continue on and look at the Qs. The Qs haven't had nearly as good of a bid as the S&P 500, but you can see it's also within that rising wedge structure. Like I said, the return of the wedges over here, the worldwide wedge. So if it breaks out up through this, we're going to start paying attention to this anchored VWAP from the year-to-date perspective. If you take a look at the DIA, is also, which is Dow Jones, the diamonds, it's coming into a prior area of resistance. And really, if you just look at this volume profile over here, it's measuring from year-to-date. And this right here is, you can think of it as a distribution curve too as well. And you can see that price got way extended from it and it comes back, right? And if it gets way extended, it can come right back down to it. So right now it's just, and you can see with the price, it's just been chopping and is hanging around where the most volume traded for the year. Now, if we take a look at the IWM is in this flagging structure. It's right there sitting on the year-to-date anchored VWAP. And if you look here, you have this window volume gap where there wasn't much volume traded. So if it can get above it, start looking at about 195 for potentially a hang up there on the IWM if it can break through this, and then just see a big rocket like move, like kind of like it did right over here, and then it gets stuck. It got stuck right here around that volume node. If we continue on and look at XLK is also in this rising wedge structure, well below its year-to-date anchored VWAP, and it's also within this kind of just open gap of volume. So if we get a stronger push, it'd still be within this structure, and if it does, we'd start looking at around 144 for the upside potential there. Consumer discretionary, this is one of the big sectors here, and it's actually kind of interesting to me because we have a small time inverse head and shoulder potentially forming here, and if it starts breaking this neckline, you can see actually it's right here near this volume shelf, and it kind of just opens up from that point. So if we get some sort of move, like it's possible that we see something like that take place from a bullish perspective. But you got to look at the top holdings in XLY. You're looking at Tesla, so that means Tesla has to continue to rally in its bearish context. Home Depot, it's been doing all right, but these things are getting a little extended, so it might need more time to actually be able to pull up into those areas. But if it does start breaking out, people start looking at that year-to-date anchored VWAP. That'd be a very nice rally from that kind of a perspective. There's a couple ways to look at this. I mean, you can look at this and potentially call it even a diamond bottom. It honestly looks like the inverse of energy, which we'll go over here. Actually, I'll just bring up energy right now, and I'll bring up energy right now. Energy right here is putting in potentially a diamond top. I was looking at this as a potential wedge too. It's potentially just wedging. It potentially already broke down from the wedge, and you have kind of just this rounded top here. It looks like it's getting pretty weak as it's trading up here, going through a period of distribution. And if you look here at this volume shelf, if it starts breaking down, there's really not much volume in this area. As you can see, it fell straight down and it went straight up. So if this starts breaking down, we might see a hit down to around the 80 marker, potentially even lower to maybe that anchored year-to-date anchored VWAP. And that would be just a great trade from the short side. If we take a look at XLF, financials are trading above its year-to-date anchored VWAP, and it's above this volume shelf with a little bit of an open gap here too. So if financials want to continue to run, start looking at 3683 to the upside, where we had prior area of support, and then it broke down right over here, and you can see that we haven't really tested it yet. So that's going to be one to keep an eye on there too as well. XLRE is also a rising wedge structure, bear flag, right? A big strong move down. We're getting a bounce, right? Expansion leads to contraction, and it has potential upside even up into this area up here, which is 4150 maybe, perhaps. And if it starts breaking down, start looking at maybe around 36 for a potential area of support. If we take a look at IBB, so this is biotech. This one I find kind of interesting because there's a couple of different biotechs that I look at. So for example, if you look at like XBI, XBI on a weekly time frame, it's getting very tight, and it looks like it could potentially start breaking out of this. It looks like a bear flag, but it could potentially break to the upside. And I'm looking at IBB here, and either this is going to be just one heck of a bull trap, or it's going to be the start of something really big. So if you look from a year-to-date perspective at this volume shelf profile, price action is getting right above it. And then from a bullish, technical pattern, you have an inverse head and shoulders, which could take us, bam, right to around 165 on a full measured move. So that would mean we're just at the start here of a potential big gaining sector in the coming future. So that is also a possibility, but we'll see here. It's already made a big, huge run. It's getting above these areas, which looks good, but yeah, you got to, like I said, I stated a lot of things about tightening and what that might look like for this. I don't know. I don't have the exact answer, but what I do know is, at least if you're trading this, where would you place a good stop? So for example, if you traded this from the upside, you saw this little flag pattern and it started breaking out of this, you can have a stop here, or you can have, 75% stop here and a 25% stop for the remainder here, or figure it out how you want. Maybe you want the stop under the year-to-date anchored VWAP, maybe 50% here, 50% there. So if you get stopped down, it comes down and then goes something like that, you'd be like, well, I still have 50% of the position in, right? There's many things you can do. Now let's take a look at some of the indicators just to get an idea of, hey, are things hot right now? Should I back off, pedal to the metal? I don't know. Let's take a look at BPCO and PQ. These are the bullish percent index charts, and I like to overlay the RSI on them because it gives us an idea of when things are overbought and oversold. So one thing is, when we get some negative divergences, what has happened in the past? Well, the most recent one here was in August. So August, we had the bullish percent index move from a high to a higher high, whereas we had matching highs on the RSI. That marked the top of the August bear market rally, boom, to the downside. Now we're seeing something very similar where we have a high to a higher high. We have a high to a lower high on the RSI. Okay, so that right there is a negative divergence on the NASDAQ composite, and the NASDAQ composite is a big index. Okay, if we continue on at the NYA, also a very broad market over here, the New York Stock Exchange, you can see negative divergences building here too as well. And when things got overextended, prior to the upside, you can see that was right around that August peak there too as well. And we'll look at a couple more indicators here momentarily, but let's look at a couple more of these bullish percent charts. Negative divergence forming on the Dow Jones Industrials. Negative divergence forming on the bullish percent for the S&P 500. This one is not quite overextended, but you can see that there is a subtle divergence on the NASDAQ 100 bullish percent index. And if you look at the bullish percent index for the technology sector, clear negative divergence there. Those are the bullish percent charts, all that are big two sectors, all showing those negative divergences and potentially getting overextended. Now, if we take a look at advanced decline volume line, I found this to be interesting when we reach up into these RSI levels that are getting a little frothy. I marked them with red circles, and then I marked it just so you can see here on the NYSE where it came to. So you can see when the RSI of the advanced decline cumulative line got extended, it actually led to some market sell-offs. The most recent one being the top of the August. So is this going to consolidate, or is it going to pull back something, very bearish? We don't know, but we at least can be aware that, hey, if it starts flagging, doing something like that, and we don't get some sort of crash, well, but still, maybe it'll work off these levels. And then you can say, if it starts breaking back out, I can add more exposure in and then, move the stops up as they go. A couple other things I want to go over into volatility. This has finally crest through the 1.20 marker. This is looking at back month versus front month. And the last times that this has happened, well, you can take a look right over here. That was in August, and then prior to that was April. So this right here, if I look down at the S&P 500, bam, 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 this is looking like it could be potentially, that was one, this is two. Is this part three of the bear market, or is it just going to come off and we're going to be okay? The brown shaded area is the VIX. So the VIX here, you can see it's coming down to its lower range. You had the VIX here when that happened. You had the VIX here when this one happened over here too as well. So it's looking very similar overall. This indicator I've liked to look at, but I haven't seen it for a while. The last signal that triggered off was you saw like very subtle pops, but if that was it, that was kind of weak. So I just marked them with dashed lines. Basically what this shows me is the rate of change between tips and treasury bonds gives us some insight into potential volatility around the corner. And it's worked incredibly for the most part, except for these last trigger right over here, which is around the same time. And if you look back, these solid red lines, not the green ones, the red ones focus on today, are when that triggered a rate of change of 1.3% or higher. And you can see when that happened, look at what happened to the VIX shortly after. Boom, popped, boom, pop, boom, 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 little boom, bigger boom. This was a no boom. But we're getting back into this area again, which tells us, hey, is the VIX, as it's pulling down, you can see it right here. This was part one, right? Part one, part two, and now we're pulling into part potentially 3. And you can see that also here as we described on this chart, but this is looking at back month versus front month. Let's take a look at the summation index. The summation index still hasn't crossed over, still trending up, so that's a positive sign. And we still have that negative divergence that's forming there on the Nasdaq McClellan oscillator. Going to continue to watch that one. If you take a look at the summation index for the NYSE, right, the New York Stock Exchange, it is still pointing straight up, so everything is good there. We do have a pretty gnarly divergence still in the works there with the NYMOT. You can really see that clearly here. I'll zoom into it, and you can see that, hey, in August on that bear market rally, we had a negative divergence. Right now, we have a negative divergence. We had a negative divergence also here in May, and then guess what? At that April, we also had a negative divergence. So that was part 1 there of that bear market rally. Then we had a bear market rally 2, and this is bear market rally potentially 3. Could market bottom. We don't know yet. People that say they do know don't actually know, right? Anything could potentially happen. It's very hard to determine. But as we can see on this chart, what it is telling us is the prior divergences resulted, and they finished they've resolved to the downside. Does that mean it's going to resolve to the downside? I don't know. We'll watch this zero line. If it starts crossing down through zero, that could be a warning shot where you can get some further momentum to the downside. Now, this also works with positive divergences. You can see the lower lows here on the New York Stock Exchange where we had the indicator reading higher lows. That resulted in rallies too as well in both the bear market rally 1, bear market rally 2, and bear market rally 3. That's all I got for you in today's episode, everybody. Hope it helped out, gave you some insight into what it is that I'm seeing in the market. Make sure to subscribe and like the video if you haven't done so already. See ya later.